Welcome back to MarketSnap, your daily market rundown. One name moved 17% today and stole the spotlight, but the broader market still sent signals. We're unpacking Shopify first, then the session's bigger themes. Let's get into the tape. The Dow and S&P 500 hit fresh record highs yesterday, but today was a bit of a mixed bag. The S&P 500 slipped a fraction, closing just below the 7,700 mark, while the Dow managed to eke out another gain. The Nasdaq, however, pulled back nearly 1% as some of the big tech names took a breather. What's interesting here is that the S&P 500 is now up over 20% year to date, and we're seeing a market that's broadening out. The equal weight index is actually outperforming the cap-weighted one, which tells you the rally isn't just about a handful of mega caps anymore. The Nasdaq's pullback today was driven by some post-earnings selling in the chip space. AMD dropped 7% despite a record quarter, and that spilled over into the broader semiconductor complex. But here's the thing. The Nasdaq 100 just logged one of its top 10 bullish stats of the past decade, with a $3.5 trillion gain in just 4 days. So this is a market that's catching its breath after a massive move. Now let's talk about the big winners. Shopify absolutely ripped today, up nearly 17% after reporting blowout earnings. AI-referred traffic to Shopify stores tripled year over year, and orders through those AI channels tripled right along with it. That's the agentic commerce story playing out in real time. Also catching bids were the gold miners. Agnico Eagle jumped nearly 10%, Newmont was up over 6%, and Barrick gained 7% as bullion continues its relentless march higher. Eli Lilly added nearly 5% after raising guidance on monster GLP-1 demand, and Amgen popped over 4% on its first $10 billion quarter. On the flip side, SpaceX was the big headline loser, down over 13%. The company beat revenue estimates in its debut earnings report, but the market was spooked by a staggering expansion in AI spending. And with over $100 billion worth of shares unlocking tomorrow, there's some real supply overhang here. Retail investors are buying the dip, but this one's going to be volatile. Uber dropped 5% despite a positive robotaxi development, and the memory chip trade, SanDisk, Western Digital, pulled back after a massive run. Nvidia was the most active name, up over 3% after a major tech player singled out its AI platform as the best and committed to using its GPUs exclusively. That's a nice vote of confidence amid all the AI capex scrutiny. Alphabet, on the other hand, fell 4% after announcing a sweeping AI leadership overhaul. Jeff Dean, one of the company's earliest employees and a key architect of its AI strategy, is leaving to start his own company. That's a significant brain drain moment for Google. Volume-wise, Intel was active but flat, new holdings and Grab were quiet, and Snap continued its slide, down 8% as the market digests its mixed quarter. We're in the thick of earnings season, and there's still plenty on the docket. Nike reports Tuesday, and that's always a bellwether for consumer spending. Constellation Brands is also on tap, along with General Mills. AeroVironment reports Monday, and we'll get FactSet and Greenbrier midweek. The big theme across all of these is going to be consumer resilience. Are people still spending, or are they pulling back? Zooming out to the weekly movers, the AI infrastructure trade is absolutely on fire. CoreWeave is up 34% on the week, Palantir has gained 34%, and Coherent, Nebius, Lumentum, Astera Labs, all up over 28%. This is a powerful risk-on signal for the AI trade, and it's happening despite all the hand-wringing about capex sustainability. The weekly losers tell a different story. Roblox is down 25% after a rough quarter, and Novo Nordisk has fallen 12% as competition in the GLP-1 space heats up. Tesla is down 22% on the month, and SpaceX has shed 21% in the last 30 days. Sector-wise, technology is leading the charge this week, up over 8%. Basic materials and industrials are also strong, up 5% and 6% respectively. Healthcare is quietly gaining ground too. Investors are rotating into the sector as a defensive play with better valuations. Laggards are utilities and real estate, both down on the week as rising yields make their income streams less attractive. Energy is flat despite the geopolitical headlines. Now let's talk about the macro backdrop, because there's a lot going on. The Fed is front and center. Chairman Warsh has floated the idea of holding fewer policy meetings, maybe fewer than the current 8 per year. That's part of a broader strategy to reduce the central bank's communications with markets. And Minneapolis Fed President Kashkari said, now is the time to start slowly moving rates up. That's a hawkish tilt that the market is still digesting. On the geopolitical front, there's real progress on the Strait of Hormuz. Treasury Secretary Bessent said a deal with Iran could come today or tomorrow, and Iran has signaled it's open to allowing European nations to clear mines in the strait. Oil dropped 5% on the news, and that's a tailwind for the broader market. The economic data was mixed. Private sector hiring came in at just 44,000 jobs in July, well below the 70,000 expected. But services sector activity continued to expand, with the ISM index at 54.1. The K-shaped economy debate is still alive. Treasury Secretary Bessent says it's over, but the data tells a more complicated story. One more thing to watch. The Fed and the New York Fed are launching a pilot survey of the private credit market, which is now estimated at $1.3 trillion. That's a signal that regulators are starting to pay closer attention to this growing corner of the financial system. You can find exclusive earnings transcript summaries on MarketSnap. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in. If you found this helpful, make sure to subscribe and hit that notification bell so you never miss a daily recap. And check out our exclusive SWOT analyses and earnings transcript summaries to take your research to the next level. See you tomorrow.